You could already be on a federal watch list and not even know it. The trigger wasn't some massive illegal scheme. It might have been a single $200 cash deposit. Maybe it was from selling a bike on Marketplace, paying your rent, or sending money to a relative. This isn't a dystopian movie plot. This is the new reality of American banking. For decades, only big money got noticed. Now that rule is dead. Banks and federal agencies are no longer just looking for duffel bags full of cash. They're using powerful algorithms to hunt for patterns in transactions as low as $200, quietly reviewing your entire financial life. You've probably seen the viral videos and screaming headlines about a new $200 bank rule that punishes cash and watches every dollar you move. They claim your financial freedom is gone, and an era of insane surveillance is here. But what's the real story? Is there a secret new law designed to trap ordinary people? Or is something far more complex and just as concerning happening behind the scenes? We're going to pull back the curtain on what's truly going on. We'll dig into where this $200 rule narrative came from, separate the myths from the facts, and expose the real regulations that are changing banking forever. Because in this new financial world, what you don't know can absolutely hurt you. Section 1. The myth of the $200 rule. All right, let's get straight to the point. Is there a new law or federal regulation that says any bank transaction of $200 will be automatically flagged? The answer is a simple no. There is no official $200 rule on the books. The long-standing, legally required threshold for reporting large cash transactions hasn't changed. Under the Bank Secrecy Act, BSA, banks must file a Currency Transaction Report, CTR, for any cash transaction over $10,000 in a single day. That law has been around for decades. In fact, there's a bipartisan push in Congress to raise these limits, not lower them. A bill introduced in late 2025, called the Streamline Act, proposes bumping the CTR threshold from $10,000 to $30,000 and raising other reporting thresholds too. Supporters argue the current limits are ridiculously outdated and just swamp law enforcement with useless data on normal transactions, creating privacy headaches for regular people. So if the official number isn't $200, why is everyone panicking? Where are these viral videos and stories coming from? The fear isn't born from a total lie, but from a dangerously twisted truth. The narrative comes from a massive misunderstanding of three real and very powerful financial surveillance tools: Suspicious Activity Reports, SARs, Geographic Targeting Orders, GTOs, and the complex algorithms banks now use to watch what you do. Think of the $200 rule as an informal tripwire, not a formal law. It's a number that shows how banks, under huge pressure from regulators, are zooming in their microscopes to scrutinize smaller and smaller transactions. They're looking for patterns of suspicious activity because criminals don't move big, obvious sums anymore. They use networks to move hundreds of small payments. In response, regulators essentially told banks to look closer, not just at who and where, but how often and how small. And that's how normal people get caught in the crossfire. Your harmless, everyday transactions can now accidentally fit the profile these new algorithms are built to hunt. This is the real issue. Not a single rule, but a massive shift in how every single dollar is watched and analyzed. Section 2. The real mechanisms, SARs and structuring. To understand how a $200 transaction could actually cause you problems, you need to forget the CTR and get to know its much more powerful and secretive cousin, the Suspicious Activity Report, or SAR. While a CTR is an automatic neutral report for any cash transaction over $10,000, a SAR is filed when a bank suspects that a transaction might involve illegal funds, is meant to hide money, or just has no obvious lawful purpose. And here's the scary part. A SAR has no minimum dollar amount. A bank can file a SAR for a $200 transaction, a $50 transaction, or even one with no money involved if they think it's suspicious. And when they file it, they don't tell you. It goes straight to the Treasury's Financial Crimes Enforcement Network, FinCEN, creating a permanent record with your name on it. So what makes a transaction suspicious? It's usually not the amount, but the pattern. The most common trigger for regular people is something called structuring. Structuring is when you break up big transactions into smaller ones to avoid that $10,000 CTR report. For example, depositing $9,500 in cash on Monday and another $9,500 on Tuesday looks like you're trying to stay under the radar. In late 2025, FinCEN issued guidance to clarify that just being near the $10,000 threshold isn't enough on its own to demand a SAR. However, the guidance also stressed that banks must file a SAR if they suspect you're trying to evade the reporting rules. And that's where the algorithms take over. Banks use sophisticated automated systems to hunt for these patterns. Here are a few things that might raise a red flag. Frequent cash deposits or withdrawals that are just under the $10,000 limit. Lots of small dollar wire transfers going to or from places known for high-risk activity. A sudden change in your account behavior, like a dormant account that suddenly has tons of small deposits. Depositing cash and then immediately wiring it somewhere else, especially overseas. The online rumors often exaggerate this, claiming that a $300 deposit and a $250 withdrawal will get your account frozen. That's an oversimplification, but the idea is real. A YouTuber who flips items for cash and makes a lot of small deposits could get their account flagged because the pattern looks like illegal activity. Banks don't judge your guilt or innocence. Their computers just make decisions based on risk. If your pattern looks weird, they might just close your account first and ask questions later. This shift from big single transactions to patterns of small ones is what's really driving the $200 rule anxiety. Section 3. Geographic Targeting Orders, GTOs. The exception that fuels the fear. While there's no nationwide $200 rule, there have been real cases where the U.S. government has enforced a $200 reporting threshold. This is done through a powerful but limited tool called a Geographic Targeting Order, or GTO. A GTO is a temporary order from FinCEN that forces financial institutions in a specific area to follow stricter reporting rules to fight a specific type of crime. These are not permanent nationwide laws. They're targeted short-term measures. For example, FinCEN has used GTOs to make title insurance companies in big cities like New York and Miami report the real people behind shell companies making all-cash luxury real estate purchases. The $200 rule story really blew up because of a GTO issued in March 2025. This order specifically targeted money services businesses like check cashers and money transfer services in 30 zip codes along the U.S.-Mexico border in Texas and California. The order forced these businesses to file reports on cash transactions over just $200, a huge drop from the usual $10,000. The stated goal was to fight money laundering by Mexican cartels. This was an unprecedented move that sparked immediate backlash from privacy advocates. However, the sensationalist videos often leave out what happened next. After industry groups pushed back, warning the low threshold was unmanageable, FinCEN allowed that specific GTO to expire later in 2025 and did not renew it at the same low threshold. GTOs prove that the government can and will lower reporting thresholds to microscopic levels when it feels it's necessary for a specific region. But these are surgical strikes, not a carpet bombing of everyone's financial privacy. The fear-mongering narrative takes a real, but temporary and localized, $200 GTO and dishonestly sells it as a new permanent rule for all banking across the entire country. Section 4. The real banking revolution. Open banking. While the internet obsesses over the mostly mythical $200 rule, a far bigger and more concrete revolution in banking is already here. It's the CFPB's rule under Section 1033 of the Dodd-Frank Act, but everyone just calls it open banking. This is not a myth. It's a finalized regulation that will fundamentally change your relationship with your own financial data. The rule, finalized in October 2024, requires financial institutions to make your data, account balances, transaction history, borrowing costs, available to you and to third parties you authorize. This will happen through secure digital portals, with implementation starting for the largest banks in 2026. On the surface, open banking is pro-consumer. The whole point is to break the data monopoly big banks have held for decades. By giving you the right to securely share your own data, the rule aims to supercharge competition. It'll make it easier to switch to a bank with better rates, use a new budgeting app, or get a loan from a new fintech company. The idea is, if you can take your data with you, companies will have to compete harder for your business, leading to better products and lower fees. However, many of the same videos talking about the $200 rule also point to open banking as the final nail in the coffin for financial privacy. They argue that forcing banks to create these data-sharing pipelines is just a backdoor way to create a system where your every transaction is logged, shared, and analyzed forever. Here's the crucial detail they leave out. The entire system is based on your permission. The rule mandates the data can only be shared with your explicit authorization. You are in control. A third-party app can't see your transaction history unless you say so. But this is a double-edged sword. While you hold the keys, the convenience of modern apps will constantly tempt you to hand over a copy. Every time you link your bank account to a new service, a budgeting app, an investment platform, a credit monitoring tool, you'll be using this open banking framework. This creates a new and complex job for every single one of us. You have to be vigilant about which companies you trust and what permissions you grant them. Recently, the CFPB has even signaled it may revisit and refine parts of the rule before it takes full effect, showing that this new landscape is still evolving. The financial world is being rewritten, and the line between truth and fear is getting blurry. Understanding the real rules is your best defense. To stay informed on actual policy changes like open banking and learn how to navigate this new landscape safely, make sure you subscribe and hit the notification bell so you don't miss a critical update. Section 5. The future of cash and how to protect yourself. With all this talk of more scrutiny and digital tracking, the big question becomes, is the government trying to get rid of cash? The war on cash narrative is a powerful one, suggesting that making cash suspicious is a deliberate strategy to push everyone into a fully digital and therefore fully trackable system. Let's be clear. There is no credible government policy to get rid of cash. Cash is still legal tender, and the U.S. is nowhere near becoming a cashless society. However, it's undeniable that the environment for cash users is getting tougher. Some stores are going cashless for convenience, and the increased scrutiny from banks on cash-heavy activity is very real. The claim that cash is being punished is an exaggeration, but it comes from a real side effect of anti-money laundering efforts. When banks are pressured to find suspicious patterns, a person or business that uses mostly cash will naturally stand out more. It's not a targeted attack on cash, but a consequence of a system designed for digital transparency. So how do you operate in this new environment without raising unnecessary red flags? First, understand what not to do. Do not structure your deposits. If you legitimately sell a car for $12,000 in cash, deposit the full $12,000. Be ready to tell the bank where the money came from. The CTR form that gets filed is neutral. Trying to avoid it by making two $6,000 deposits is what actually looks suspicious and will likely trigger a SAR. Second, if you have a cash-heavy business or gig, keep flawless records. Good bookkeeping is your best friend. If your bank ever questions your transactions, being able to show legitimate invoices, receipts, and sales records can clear things up instantly. Third, be smart about your transactions. Use digital methods for large, easy-to-document payments. If possible, avoid making frequent pattern-like cash deposits. For example, instead of depositing $300 in cash every 2 days, it might raise fewer flags to deposit a larger sum once a week. Finally, guard your own data in the new world of open banking. Before you link your bank account to any new app, read the terms. Understand what data you're sharing and why. Uncheck any permissions that aren't absolutely necessary for the service to work. In the end, the 200 new bank rule is more of a symptom than a disease. It's a sensational story born from a real and growing ecosystem of financial surveillance. There is no single secret rule that suddenly made a $200 transaction suspicious for every American. The reality is a combination of different things. The ever-present threat of a suspicion-based SAR, which has no dollar minimum, the targeted use of GTOs that have temporarily dropped reporting down to $200 for specific areas and reasons, and the powerful algorithms that are programmed to see the ghost of crime in the machine of everyday life. The biggest, most tangible change is not some phantom rule, but the arrival of open banking. It will reshape our idea of financial data ownership and force all of us to become active managers of our own privacy. Don't let fear paralyze you. The goal of this system isn't to punish ordinary people, even if that's sometimes the unfortunate result. By understanding the real rules, what a SAR is, what structuring looks like, and how open banking actually works, you can navigate this new world with confidence. The antidote to fear isn't ignorance, it's knowledge. And in today's banking world, knowledge is the ultimate form of financial freedom.